Have you ever wondered why some people's investments keep paying them every single month, even when the market feels slow? No trading, no side hustle, just steady deposits landing in their account month after month. It's not luck, it's structure. It's the power of monthly dividend stocks. Unlike most companies that pay dividends every 3 months, these ones pay you 12 times a year, giving you smoother cash flow, faster compounding, and for some people, a quiet path to financial freedom. In today's video, we are breaking down 5 monthly dividend stocks that pay consistently even while you sleep. But more importantly, I'll show you how to actually build an income portfolio around them. Whether you're a 9-to-5 worker, freelancer, or someone just tired of watching inflation eat away your savings, this video is for you. Hello my colleagues, welcome back to the channel. Before we jump in, please do me a quick favor, smash that like button so more investors can get to see this breakdown. Subscribe to the channel if you haven't already, and you can as well join my WhatsApp channel. Link is in the description and pinned comment. That's where I share my research, what I'm tracking in real time, and opportunities before they hit my YouTube channel. And if you like a personalized plan for building your own income focused portfolio, or just want clarity on where to start in terms of your investment journey, you can also book a one-on-one session. The link is in the description and pinned comment. Without much talk, let's jump right into today's video. Let's go. Before we get into this list, let's take a quick step back, because it's easy to hear monthly dividends and think it's just a marketing trick, but it's not, guys. It's one of the most practical ways to build real predictable cash flow, especially in uncertain markets like Nigeria. Here's the reality. Most companies only pay dividends 4 times a year. That's once every 90 days. So if you are trying to live off your portfolio or invest those payouts, you are sitting on idle cash for 3 months at a time. Now compare that to companies that pay every month. You are not just getting 12 smaller payments, you are compounding 12 times instead of 4. That simple difference, the timing of cash flow, can boost your long-term returns by 1 to 2% even with the same total dividends, and the benefit goes beyond compounding. If you are retired or working towards financial freedom, monthly payers smooth out your income. It's easier to plan bills, rent, or savings goals. If you are investing, you can buy more shares sooner, which means every dollar starts working faster. And if you are in a place like Nigeria where inflation eats your cash flow every single month, having a monthly source of income in dollars can be a real financial shield. So this isn't about chasing high, it's about creating financial rhythm. Your job pays monthly, your expenses come monthly, so why shouldn't your portfolio pay you monthly? Get that right? Now that you understand why these stocks matter, and before we jump into the 5 dividend stocks to buy, let's talk about what makes a good dividend stock. These are what to look out for before buying any of them. This is the part that separates a real investor from someone just chasing flashy yields, because not every stock that pays monthly is worth holding. You see, most people open a dividend list, scroll straight to the highest yield and stop there. We don't do that here. We care about sustainability, because a high dividend that collapses next quarter isn't income, it's illusion. So how do you tell the difference between a dividend that is solid and one that is hanging by a thread? Let's break it down. First is the payout ratio. A company can only pay dividends from what it actually earns, but here is where many investors get fooled. The normal payout ratio you see online uses net income, which can be distorted by accounting mirage or tricks or one-off losses. The smarter way is to look at cash flow. For real estate companies especially, right, ignore net income and check for something called AFO, which stands for Adjusted Funds from Operation. That tells you the real cash they generate after expenses. For financial firms or business lenders known as BDCs, the key metric is NII, which stands for Net Investment Income. Now here's the rule of thumb. If the company is paying out less than about 80% of that real cash flow, you can sleep well. If they are paying 100% or more, that dividend is living on borrowed time. Because the truth is, the yield doesn't matter if the payment is a ticking time bomb. Next is the history and type of business. You want companies that pay money predictably, not hype stocks, not the next big tech thing, but boring, reliable cash flow machines. The best monthly payers usually come from sectors that are legally required to distribute profit or operate on steady contracts. So you want to think right: energy infrastructure, BDC. BDC stands for business lenders collecting interest payments from small and mid-sized firms. We also have managed rights. These are basically funds that generate cash every month using strategies like covered calls. And here's the golden rule, guys. If a company has maintained or even raised its dividend 5 years or more across different market conditions, that's your signal. That's not luck, that's discipline. Finally is the currency angle, or what I like to call the Nigerian edge. If you are investing from Nigeria, the currency you earn in matters just as much as how much you earn. A dividend paid in dollars doesn't just give you income, it gives you protection, because while Naira loses value every month, your dollar income holds steady or even grows in Naira terms. That's why I always tell investors back home, don't just look at high yield, look for hard currency yield. It's your built-in hedge against inflation and currency devaluation. So before you buy any monthly dividend stock, ask yourself these questions. Can the company actually afford it? Have they proven they can keep paying through different cycles? Is their business model predictable or just popular? And is my income coming in strong currency that holds its value? Because remember, true wealth isn't built by chasing yield. It's built by owning systems that never stop paying. Now that we have set the standard, let's get into the exciting part. The 5 monthly dividend stocks that actually walk the talk. And we'll start with the gold standard of monthly income, named Realty Income. This is the king of monthly income and the perfect foundation for a dollar cash flow portfolio. Now here is what they do. Realty Income is essentially a mega landlord. They own over 13,000 properties across the US and Europe, from convenience stores to drugstores and fitness centers. They lease this out on triple net leases, meaning the tenants pay for the taxes, insurance and maintenance. This creates a remarkably predictable stream of rental income. It typically yields around 5.7% currently, which is excellent for a company of this quality. Now, here is why it is sustainable. This is the key actually. Their dividend is covered by an AFO payout ratio of around 75%. Like I said earlier, AFO stands for Adjusted Funds from Operations. It's a key financial metric used primarily to evaluate the performance of real estate investment trust rights, and their AFO is comfortably below the 80% danger line. Furthermore, they are an S&P 500 dividend aristocrats, having declared over 650 consecutive monthly dividends with an increase in the payments for 30 consecutive years. They are truly disciplined. But here's one caution: because of their stability, they tend to be sensitive to rising interest rates in the US. When rates go up, new investors can get similar yields from safer investment tools like treasury bonds, which temporarily makes the stock less attractive and can pull the share price down. So while Realty Income is built on necessity retail, the next stock on my list still stays in the real estate space but shifts its focus entirely to the boom in e-commerce and logistics. We are talking of Stag Industrial with the ticker symbol STAG. STAG is a specialist right that owns single-tenant industrial properties. Think massive warehouses, distribution centers, and light manufacturing facilities. These are the buildings that keep Amazon, FedEx, and countless other businesses running. They are a direct play on the growth of e-commerce and the need for faster logistics. Their yield is a bit lower, typically around 3.8%, but here is why it's sustainable even though the yield might not be very high. You see, industrial properties have high occupancy rates and long-term leases, making the cash flow exceptionally predictable. Their dividend is protected by a solid cash flow coverage ratio of less than 70%. This gives them a significant cushion to absorb any economic shocks and to continue their modest monthly increases. On caution though, guys, because of the lower yield, their returns are more dependent on share price appreciation. If there is a sudden slowdown in the manufacturing sector or e-commerce sector, the stock price and the overall return could be affected more than the dividend itself. You need to be aware of this. Now, let's leave the world of property and dive into one of the most reliable sources of monthly dividend income you can find. I'm talking about private lending. This is the realm of business development companies. You can call them BDCs. We are talking of none other than Main Street Capital with the ticker symbol MAIN. Main Street is a business development company, BDC. Think of them as a private bank that lends money or provides equity to small and mid-sized profitable US businesses that are too large for a regular bank loan but too small for the public market. They make money by collecting high interest payments on those loans. Now, talking about the current yield, this is where BDCs shine. Main's regular monthly yield is high, typically around 7.2%, and they often pay large special dividends multiple times in a year, boosting the overall return even further. Now, here's why it's sustainable. Their net investment income (NII) comfortably covers their regular monthly dividend, keeping their NII payout ratio well below 80% because their loans often have variable interest rates. As US rates go up, their income stream also goes up, directly protecting the dividends. One caution though, because their income is tied to private business health, they are exposed to credit risk. If the US economy enters a severe recession, some of the smaller businesses they lend to would default, which would threaten the large special dividends. Our next talk moves us back to real estate, but introduces a little more risk and a much higher potential reward by focusing on experiential properties. I'm talking about EPR properties with the ticker symbol EPR. Like I said, this next one is for investors who like a bit more yield and a bit more excitement. EPR properties is a specialized right that focuses on experiential real estate. Think movie theaters, sky resorts, and family entertainment centers. Now, I know what you are thinking. Those sectors took a hit during COVID-19. Yes, you are very, very correct. And that's what makes EPR's comeback story more impressive. After freezing dividends during the pandemic, they not only restored them, they raised them. Right now, the yield is around 7.2%, fully covered by operating cash flow. The beauty of this company, or will I say this right, is in its diversification. Their tenants sign long-term leases tied to entertainment, education, and recreation. So as long as people keep going out to relax, learn, or play, EPR gets paid. Now, the risk is the right is cyclical. How do you pronounce cyclical? I hope I pronounce that right. So it means that when consumer spending dips, leisure slows down, but the recovery in hospitality and entertainment currently has kept their cash flow resilient so far. If you are comfortable with slightly higher risk, higher yield positions, then EPR adds flavor and serious monthly income to your portfolio. Finally, on our list, we have JP Morgan Equity Premium Income ETF. Now, not everyone wants to pick individual companies. That's just the truth, and that's perfectly fine, by the way. That's where JEPI comes in, a monthly dividend ETF that combines blue chip US stocks with an option strategy to generate steady income. Now, here's how it works. JEPI owns large cap stocks like Microsoft, Johnson & Johnson, and Pepsi, but also sells covered calls on those holdings. That's a little bit complicated, but yeah, that's what they do. That strategy actually creates extra income, which is distributed to investors every month. The current yield is around 7.5%, and the best part is that it is fully managed by JP Morgan's professional team, so you don't need to do anything. It's designed for stability, low volatility, consistent payout, and broad diversification. The only catch is that in a fast rising bull market, JPI's returns might lag because selling call option caps your upside. But for income-focused investors, that trade-off is worth it. JPI is perfect if you want dollar-denominated passive income without the stress of managing multiple stocks yourself. So there you have it, guys. 5 proven monthly dividend payers that combine stability, consistency, and sustainability. Now that you have seen the players, let's put them together, because owning these stocks separately is good, but structuring them into a system that pays you every month, that's where the real magic happens. Let's make this practical, guys. So let's say your goal is to earn $100 every month or $1,200 per year in dollar income from dividends. Before we even talk about which stock to buy, the first question you need to answer is, how much capital do I actually need to earn that income? And here's a simple math. If your portfolio yields around 6% per year, which is realistic for a mix of strong monthly dividends, for example the ones you have covered, then every $10,000 you invest will generate you roughly $600 per year. So to earn $1,200 per year or $100 minimum, you need to invest roughly around $20,000. That's your starting point. Now, once you know your capital target, the next step is to decide how to allocate that money, because balance is what makes the income sustainable. Let's jump into my laptop for a moment. I'll show you how best to allocate your money using these funds that I have covered in this video. Jump into the laptop and looking at our Excel sheet, you can see the different companies, or let's say rights and ETFs that we talked about, all segmented. So for realty income or stag industrial, you have to choose between them. You put in 40%. So 40% of your $20,000 goes into this particular investment, and the allocation is around 40% of $20,000 is $8,000, right? So that's like yielding 5%. You're looking at an annual income of $400 from this investment. Then looking at Main Street Capital, you have to choose between Main Street Capital or EPR properties. You're going to put in like that 5% of your money, which is about $7,000, which is high yield and growth. This one offers high yield and growth, and the yield is around 7%, yielding you, even with small money, you can see yielding $490 $90 per year, and then balance ETF, which is the JP Morgan Equity Premium Income, putting like 25%, which is about $5,000, yielding you around 7.5%, which is equal to $375 per year, right? And then you now have a very solid diversified investment mix. If you sum up all of them, is 100%, and your allocation is now $20,000, meaning you have fully invested your $20,000, and the average yield, if you add everything up and do your mathematics, is around 6.30%, and you're going to be making about $1,265 per year from your $20,000. Now, this is not big, but it's not bad. The most important thing is reinvestment, because that is where you are now able to grow this money even further. And you can look at the pie chart here, guys. So from the Excel sheet, you can see that what we have built isn't just a random list of dividend stocks. It's a cash flow engine that mirrors how real income portfolios are structured. And here's the best part, guys: it quietly compounds. Each month, those dividends can be automatically reinvested, meaning you are buying a little more of these income producing assets without lifting a finger. That's how investors gradually turn $100 a month into $200, then $500 without trading or guessing. Now, for Nigerian investors, here is a practical edge. You can literally access all these stocks through Truth, Bamboo, or Rise first. And if you leave your dividends to reinvest, you are quietly building a dollar income portfolio that shields you from naira depreciation every single month. So just to recap, you build your base of, let's say, stability with STAG. Then for yield, you look at main, then you finish it with balance, talking about JEPI. Do that and you are not just owning stocks, you are building a system that pays you like a business. Now, here's the thing: you might be thinking, do I need $20,000 to start? The answer is a big no. You can start with just $100, and with time you build it up. This kind of investing doesn't make you rich overnight, but if you stay consistent and keep reinvesting, it can buy you something even better than riches, which is freedom. The freedom to earn while you sleep, the freedom to plan your month knowing money is still flowing in even when you take a break, and the peace of mind that your money is finally working for you, not the other way around. If you got value from this video, do me a quick favor: hit the like button so more investors can discover this video, and subscribe to the channel if you haven't already, because every week I drop deep dives that helps you invest smarter, not louder. And listen, if you are watching this and thinking, Micah, I want to build something like this for myself, but I'm not sure where to start, then you can always book a session with me. Link in the description and pinned comment. We'll sit down together, map out your income goals, and create a personalized plan for building your own dividend portfolio step by step. Also, don't forget to join my WhatsApp channel. Link in the description and pinned comment. And until next time, my colleagues, Deo.